Let's go ahead and record that. Let me know when you guys can see my screen. Can you guys see my screen?
Yeah, we can see it.
Solid. So currently we're looking at TradingView. But before we get started, I just kind of want to give you guys a breakdown of what we're going to go over today. So the purpose of this call is to really just go over also backtesting. And if I can ask you guys just to mute yourselves if you aren't. Naquan, what's up, man? All right.
What's up, bro?
Cool, man. How you doing? Happy Easter to you.
Same to you, man. I'm straight. Watching these markets myself.
Right. It's gonna be a powerful week, man. There's a lot of pins moving.
Yeah. I'm just saying. Gonna see what you're gonna do. I'm watching you. I'm driving right now, so I'm just gonna be watching and listening.
Yeah. Absolutely, that's no problem. So we'll go ahead and get started. I don't want to take too much of you guys' time, so I really want to make sure that we get across the most solid points throughout this webinar here. But basically, the concept of this webinar, is to discuss backtesting, backtesting when it comes to entries, because that's something that, everyone has questions about is, when do I jump in the trade? Like, how do I know this is the right time to jump in the trade? And I just want to kind of go over, just the different tactics that you can use to determine on when's a good time to jump in the trade, when is not a good time to jump in the trade. And then kind of segueing from that part, I wanted to look at, charting, just the same concept that we went over in the previous videos of just top-down analysis, how you're going from the weekly time frame down to the 1 hour to look at, the charts and see the overall direction of the market. And then from that point, I want to discuss a few pairs that I'm watching. And then we're going to end it off with support and resistance, just to kind of rediscuss or kind of just put it back in your minds of just how support and resistance works, how to look at support and resistance, and the best way to mark it up on your charts. And, is too many lines good? Is not a lot of lines bad, essentially. So let's go ahead and get started. So first things first, before we do anything chart related, we want to make sure that we look at what is going on from a weekly standpoint to understand, all right, which pairs or which currencies have major news that's releasing. This way, you're not blindsided by taking an entry on something that you were expecting a certain movement, but it goes in opposite direction based off of, major news that releases. So in order to determine this major news, we go to a website called forexfactory.com, right? And you guys can still see my screen, correct?
Yeah, we can still see it.
Perfect. All right, so when we're on Forex Factory, we want to just kind of just look through the material and see what exactly is to come. If there's any major news that's going to be released. I kind of filtered my my charts here to kind of just show me the orange and red folders. Of course, you have the yellow and these gray folders that are by default. That's what shows up on your charts. But one thing you want to keep in mind is, it'll let you know what's going on with these gray folders, and yellow folders is kind of just a whole bunch of information that really doesn't move the market. It's the red folders that you want to pay attention to. The red ones and sometimes these orange ones, but primarily the red ones is what's going to cause, the market to move in a direction, if it's bad news or if it's good news. One thing to keep in mind, just based off of Monday, as you can see, it's a bank holiday for the Swiss franc. It's a bank holiday for the euro as well as for GBP. So with that being said, is you want to just be mindful due to the fact of, because it's a bank holidays, the banks pretty much won't be trading too much in these pairs. So you're not going to have a lot of volume or a lot of movement how we usually see with these pairs here. So whenever like a holiday happens on during the week or on a Sunday or during the weekend, you always want to come here to see what's going to happen that day or what's going to happen the day, the market opens. Is it going to be considered a holiday? Is it just business as usual? Like, is something going to take place that's going to negatively or positively impact the market? So as we can see, Monday, we had these bank holidays taking place. So, we'll just watch those charts closely, see what happens. There may be movement due to the New York session trading these pairs, but primarily we just want to kind of sit back and watch these pairs just to see what's going on. And then, of course, as the week progresses, you can see other news that's dropping. A lot of red folders, the AUD being the Australian dollar, CAD being the Canadian dollar, JPY, Japanese yen has news coming out. So this is just be mindful, when trading these pairs of just this information coming out. You don't have to worry about it, Monday for the Japanese yen or Tuesday for the Japanese yen, because that news is coming out Wednesday. So when Wednesday comes around, that's when you want to, pay attention to what's going on here. And if that news is negative, being a red number, or positive, being a green number. Okay? So after you get that information there, then you can kind of double back to the charts and just kind of sift through some of the charts. I know most of you guys like to, look at like just 6 pairs or just a few pairs just to see which pairs are actually moving. But I just have the whole 28 pairs on here. I'm not watching all 28. Don't get me wrong. I'm not watching all 28. Out of all these pairs, I'm looking at which pair's price is closest to these key levels, right? Because I like to trade near these key levels. And the reason why is because price tends to follow past history at key levels versus, trading support and resistance. A lot of you guys get caught up in the support and resistance side of things when trading because, when you're looking at, in between these key levels and you're just looking at support and resistance from a time frame like a 1 hour or a 2 hour or 4 hour or even a 30 minutes, you're missing a lot of key information, and there's not there may be confluence, meaning, it might be downtrending, it might be at a support level, and it might be at a Fibonacci level. Like all three of those things might match up at the same time, but the price may go against you, So when you're looking at these key levels, especially when you're looking at them from a higher time frame, you get an overall picture of what's going to happen when price gets back to that point. Now, this chart that you're looking at, there's a lot of lines, there's a lot of stuff going on, so it might be a little overwhelming. But let's just look at, just any pair that does not have any markings. All right, this looks like a solid one. So let's just take these lines away. So when we're looking at this pair, right? So first things first, we want to do top-down analysis. Like I mentioned before, top-down analysis is when you're looking at the overall picture of the market, what's happening in the market, and then, you kind of break it down to smaller time frames until you get to a point where you realize where price is a good entry point for your trading style. So first and foremost, we want to look at a weekly time frame. Weekly time frame, it gives us a lot of useful information. Each candlestick represents 1 week. So whenever you see things like this, or this consolidation, this is a lot of data compiled within 2, 4, 6, 7 candles. All right. You're pretty much looking at about 49 days or 42 days worth of data within these candles right here. All right. So when looking at this here, first things first, before we do anything, we want to switch it to a line chart. The reason why is because these points kind of gives us like an accurate position of where price came up to and then came back down. So what I like to do here is grab like a horizontal tool. So simply off of your toolbar, horizontal line, and just mark where you see price tap multiple times. So we have something about right there, okay? I also see something right above here. See something right about down here. See that about right there. Okay. Now, with these lines that I just drew, the reason why I drew these lines is for a specific reason. So, wait a second. Since these are my weeklies, I'm going to go ahead and name them. And as I'm going through, if you guys have any questions, feel free to ask away. Okay. So these were weekly levels to me. And the reason why I chose these levels as my weekly levels is for a specific reasons. So the real reason why I chose these levels is because of where price came. So as you can see here, price touched there. Price gapped there, meaning price came down, respected that level, went right back up. Price overlapped here. It tapped here. We had some consolidation here. It overlapped there. And then we have this overlap here, right? So this is pretty much the lowest point where price is. There's no past history to kind of tell, to kind of gauge. But as you can see, this is 2015. So about 4 years worth of data is all in this area right here, okay? And then we look at this line above that. We see that price tapped and overlapped. Price also came up and overlapped here. We see this tap right here. We see a little gap. We see a little overlap. Some overlaps here, a tap, another tap, okay? So that's another area of support. Now, these two areas are support. And there's one main reason why these are support, because price is up here. When you look at support and resistance, I want you guys to think of it as a ceiling of a home and the floor of a home. So when you're walking through your house, you're walking on the floor. This would be support, because if there wasn't any type of flooring, you would be touching the ground and you would fall into the basement, right? There's no support. Now, let's say you had a trampoline in the middle of your living room and you were bouncing up and down with other people. By the time you reach the full altitude that you can reach, you're going to be met by the ceiling being resistant. And what happens at that point? It stops you and you come back down. So you always look at resistance being the ceiling of a home, and then support being the floor of a home. So you're supported by the floor, and resistance is keeping you on the ground, okay? So you have these two areas that we like, and then we have these areas up at the top. So up at the top, we have this line that taps, right? We got some taps, we got a little bit of overlaps, we got some more taps, and overlaps, some overlaps there. Solid. We'll keep that as resistance. And then we go up a little bit further. We got some taps, some more taps, another tap, a gap. We got some overlaps going on there. So that's another solid area. Now, with these levels here, to me, there's only one level that I would consider to be a key level, and it's this level right here. I'm going to put an asterisk by it. The reason why I say that is because price was met as support here, and price was met as resistance here. So we have resistance here, we have some more resistance here, we have support here, right? We got some resistance or support here, some more support, a gap, so resistance there. And like I mentioned, resistance being a ceiling, support being a floor. Now, because price came up and came down, it was respected as resistance. Price came above it at one point and came down and went right back up. So it was respected as support. These other levels, there wasn't much of that taking place. It was more so price coming up to it and coming down, coming up to it, coming down, coming up to it, coming down. Same down here. Price just came down, went back up, came down, went back up. Price never broke past it and then respected it as resistance from the upside, okay? So now we're looking at the weekly. We done marked up all of these levels with the line charts. Let's switch it back to candlesticks and just see how price reacts in those areas. So as you can see here, we have some wicks. That's 2 weeks worth of data. right? Price kind of broke through, and then immediately shot back into the zone. We got 1, 2, 3, 4, 5, 6, 7 weeks worth of data. Another 2 weeks worth of data. We got pretty much about 6 to 7 weeks worth of data. 2 more weeks worth of data. 3 weeks of data. All at this one level. That's a lot of data, right? Then we come up here. We got some more wicks. These wicks letting you know that the buyers are coming in and they're pushing price up. They don't want price to go below this level here. More wicks. We got more wicks here. Price is being pushed up. Price is being pushed up all in this area. It's being pushed down. So sellers are saying, nope, we don't want price to come above this line. It's right where we want it, right? Price stops at this area. It stops right there at this area. So we can respect this. We can respect this as a key level. And then we come up here to this level. So we have price, flooring. We got this wick at the top, meaning that sellers are coming in and pushing it down. They don't want price to go above this green line or this little area. None of these lines is just clear cut. That's the only line that you need to worry about. It's more of a zone. So if you were to be able to draw like a rectangle area, this is what you're looking at. This area is what you're really focusing on, right? So as you can see here, we got some consolidation. Price tried to shoot above, but then we had a bearish engulfing. A powerful signal in the market to let you know that the market is going to downtrend. We have wicks pushing price above, pushing it down. So we have a lot of just commotion taking place at this level. And then the same thing happens up here at this level. Price breaks above it. It tries to stay above it. It falls back down. It does it again. It falls back down. We have all these wicks up at the top. So, it's pretty much letting us know that these levels right here are very, 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 strong. Price tends to do stuff at these levels, right? So what we want to do next is break it down to the daily level. And we're still doing top-down analysis on one pair right now. This is still just one pair. So we look at the line chart, and we see what's going on. We just kind of look. It's a little bit more messier. As you can see, there's a lot more lines. But we just want to look for just key areas that we can find. If there are any, then we'll mark it. If there aren't any or you can't find it relatively easily, then just leave it alone. It's not necessary. But I see something about right here. So we're going to change this color. Let's give it this magenta color. Daily. And what I see here, I see price tapping. See a little bit of consolidation. Price taps. A little bit of overlap, a tap, a little bit of overlap. So I'm seeing some activity take place at that area. And not only that, because price comes down and goes up and price comes up and goes down, it's a key level to me. So what I want to do is just go ahead and mark that with an asterisk to let me know that that's a key level, right? So now we'll just look through, see if we can find anything else. I see that's here. All right. So this is just support. We got price come down, go up. Price comes down, goes up. Price comes back to this area, goes up. We have a lot of that taking place from a daily level. Then let's see if we can find anything else at the top. I think we have maybe one area right about here, right? So we got this taking place. Prices being respected. We got a little bit of overlap, some gaps, overlap, price tapping. So we got that taking place on a daily. So we found 3 areas from a daily perspective, right? And then before we switch to another time frame, first things first, we'll switch it back to candlesticks and just look at those levels, see what happens, right? See what just kind of observe it. So we see this happening, some consolidation right in this area. Price comes down, shoots back up, breaks below it, retested it, and then breaks down to this weekly level. We see price not wanting to break above this area right here. So this is being very, very strong and solid. Same thing here. Price breaks above this weekly, but it's abruptly met by this daily level and shot back down. Retest the weekly, shoots down. You see, but it's kind of stops at this daily level before shooting down, right? We got a little overlap taking place here. You got this bearish candle followed by bullish, or excuse me, a bullish candle followed by bearish candles, right? So we got some overlapping taking place here. Price breaks below this daily, but then immediately shoots back into the zone, right? So this is what price is telling you right now. And this is a lot of data too. This is a daily. Each candle represents one day. So you're looking at 1, 2, 3, 4, 5, 6 days worth of data at this one level. There's a lot of consolidation taking place, right? So now that we have that and all of our dailies and weeklies marked up, now we can look at the 4 hour. So the 4 hour is what I primarily trade off of, simply because the charts are less messy and it's easier to, see what's taking place, right? But when looking at this, you don't necessarily want to take an entry just simply off of the 4 hour. You want to find, key levels, like key areas to jump into. So as I'm looking here, what I see is somewhat of a double top, right? Because price came up, came down, shot back up, it's coming down. Now price looks like it's coming right back up. Now, also at that level, I see market structure. We got some higher lows, but we got highs. So we have these. If you look from down here, right, price was falling. We had a bunch of lower highs and lower lows. But then once we got to around this area here, we started to see a change in direction. So we started to see the impulses being the buys, these legs up, and then the retracements being the sells. So all of this red area, right? So we have a low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So we see that taking place within the structure. But we were met by 2 highs, pretty much like a top. So this could be considered an area of resistance on the 4 hour. So we would want to leave this here just from like a 4 hour perspective, just to see what price does. Now, if we see any type of movement, bullish movement, where price shoots, breaks above this line, taps it, and then starts to go up, that'll tell us that price is on its way up. It's not going to fall down. But with this candle here, if this candle closes and we have a bearish red candle that shoots through this little level here, we'll be looking for some type of momentum to the downside, right? So we'll look for a break of this level, a retest of that level, and then it'll drop down to the next key level. Now, it may drop down here, or it may continue to fall down, down here to this area somehow. But we want to sit back and watch to see what's going to happen once this candle closes, and then look at the following candles to see, okay, is it going to be, strong movements to the upside or strong movements to the downside? And remember what I was saying. Keep in mind of the Forex factory, simply because, remember, Wednesday, we have news that's releasing. So do we want to be trading, or do we want to be in a swing trade on, Canadian dollar, Swiss franc, knowing that news is going to release on Wednesday? I wouldn't want to be in it. So what I would do is I would just leave this one on the radar, write it down in your book or whatnot, and just keep it on watch. Keep it on watch until it does what it's supposed to do. And if that happens on Wednesday, don't trade it until that news releases. When is that news coming out? 10 a.m. So you have ample amount of time to get up, look at the charts, see what's going on, wait for the news to drop, give it about, 5-10 minutes after the news releases to see how the market will move, how the market moves to that. Is price bullish, is price bearish, and then gauge your entry off of that, okay? Now, with that being said, you know, that still doesn't tell us how to enter a trade. Now, when it comes to entering a trade, this is probably the hardest thing. Even for myself, it's still hard, you know, entering trades. But I'm getting better at it by doing this tactic here. What I like to do is I like to back test these like levels of retracements. So I'll take my Fibonacci tool, and the last low could be drawn from here to this high here. Now from this low to this high was meant by a retracement. And this retracement came down to the 382, 0.382. What you want to be mindful of is 382 and 618. These are the two most strongest trend continuation levels that you can find in the market. When you're in an uptrend, you want to look for 382 or 618. When you're in consolidation and you get a break of consolidation, you're looking for the 50. If you see price come down to the 786, it's kind of telling you that the trend is reversing. So if it was in an uptrend and it comes down there and it continues to move in that direction, then more than likely the trend is changing and price is going to eventually come down or change the direction. So we have price at this level here, which was in the past last week. We had it stopping at the 382 level. Let's go ahead and just highlight this area, right? And then what we want to do is we want to kind of break it down into the hour time frame and see what happens, you know, at the hourly time frame. So as you can see, we have this uptrend move, you know, higher lows, and we were met by this here. So pretty much we have a ceiling taking place right about there, all right? And then we also have this little area here is what we're looking at. So we want to find some type of entrance in here to catch the pip move up, right? Because we're in an uptrend. So we should be buy bias, like looking for simply buys, no sells, you know, only buys because the market is uptrending. You don't want to trade against the direction of the market. All of this is uptrend, okay? So looking at this, we want to break it down into a 15-minute, 30 or 15 minutes. So let's look at the 30 for a second. See if we can find any type of structure, all right? This area, it's just a bunch of consolidation. Let's look at 15. So as you look at the 15-minute, you start to see a little bit more of, you know, some type of market structure. It's a little bit more, you know, clustered, and there's a lot going on, but you can still see it. And the easiest way to see it by taking the brush tool and drawing it out, right? So we have a low, our high, our low, or lower low, lower high, lower low. We had a high, but then we had another lower low, lower high, lower low, and then we had this take place. Boom, 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 right? On the 15-minute. This is what you're looking for here. You're looking for that. And I'm going to tell you why you're looking for that. Because this broke market structure. We had a whole bunch of lower lows, and eventually we had a higher low, right? That also broke out of this little channel. So we had this channel here, right? Where price was just kind of hovering within it. And then eventually it broke out of this channel, retested the channel before moving to the upside. Now, this pair here, if you look at the Forex volatility calculator, it'll tell you how much this pair moves on a daily basis. Now, looking at the CAD Swiss franc, let's see if it'll pull it up here. The CAD Swiss franc moves about 51 pips per day. When you know this will give you a gauge on how much, like how many pips you should be looking for with that pair. If I changed it from that 10 weeks to the 2 weeks, it's even smaller, 46 pips per day, right? Or excuse me, 40 pips per day. So you don't want to be aiming for 70, 80, 100 pips, like a Great Britain pound type of pair. You want to be aiming for something relative to how much that moves in that given time frame. So you're looking at 40 pips max per day, then you may be looking at, securing 10, 20 pips. Okay? So let me see something here. Looks like the meeting may end in 10 minutes, but if it does, we're going to go ahead and re-jump on and just keep it going. All right? So going back here, we know that, okay, this is the entry level, and we want, 20 pips. But before we say we want 20 pips, we got to look at how much we're willing to risk. Because from this point down to here, which was the lowest point, is about, 10 pips. So if we set a stop loss a little bit lower than that at 12 pips, right? And we want to do a 2-to-1 risk to reward ratio. And then we're looking to gain 2 times the amount we risked, which is 24 pips, we would have been right on the money. If you were to take an entry here, somewhere here. Now, the candle formation doesn't really give you a solid candle formation right here. Right here, it does. As you can see, this is a bullish engulfing, right? So if you were to take the entry here, somewhere up here, if you were aiming for 24, it would have been a reach, But from here, once you started to see that this pullback, you could have closed the trade anywhere here. You could have held it much longer if you wanted to. But with these smaller pairs where you're aiming for, 20 pips, knowing that it only moves 40 pips, you take what you can get. You can take 18 pips, take the 18 pips. If you're twin trading this, those 18 pips could be, $36. It could be $66. It could be $100, depending on your lot sizes and the risk to reward, as well as, how much you're risking on this trade or you're leveraging on that trade. So we have that taking place. And then you can simply just, when you know this here, how to backtest looking at, just market structure entries, now you can simply just go to other charts and just look at those valleys within market. So when you see market come up and then the market dips down, look at these areas right here, right? And just observe what happens. Because this is the most key area that you want to find some type of entry. So if you know how price moves in these areas, your trading game will be that much more solid. So as you can see, we had these from like right around here, we had these lower lows, lower highs, lower lows, lower highs, lower lows. And then all of a sudden we had this, boom, a higher low, right? We had that higher low take place. Followed by, it's a small version of it, but we have what is called the morning star. So we have that doji candle followed by a larger red and a larger green candle on both sides, followed by this variation pattern. So you have 3 bullish candles following this morning star. So this kind of gives you a gauge of, okay, where price is going, right? So this is under 15 minutes. So you're not necessarily risking so much on the downside, right? Based on the type of pair that you're trading. You're looking at about 20 pips at the break-even point. But if we were to go a little bit lower than that, you're risking about 25 pips of downside. So if you're risking 25 pips, you want to at least be able to double that of reward, because you never want to just be one-to-one. And you never want to take trades without knowing how far down it's going to retrace. Because based on your account size, if you take too big of a position, that position could blow you up. And I know how some of you guys trade without setting any type of stop losses. I'm telling you, if you trade without stop losses, you will lose all your money. One of these days, you will lose it. I had a friend that lost $20,000 and owes his broker money. Don't let that be you. He traded for a year. He made 20 grand over a year and lost it within one trade. One trade. That's all it takes. That's all it takes. It's the wrong news to drop, you being in the wrong position against the pair, going the wrong way, and for that to go 200, 300 pips against you within a matter of minutes, a matter of an hour, while you aren't even watching it. And the next thing you know, you're getting an email saying that you owe your broker money. You know what I'm saying? So just looking at that there, let's say that, you know, all right, cool. You're going to take the entry around this area here. You're going to take it after this Morningstar. So you want to take it here, somewhere around this area. You just take your tool and count up, you know. You're looking at about 50 pips. You're looking at about 11 hours to secure 50 pips. And just let the trade run its course. You know, if you're right, the trade is going to run its course. If you're wrong, you're just going to get stopped out at 25 pips. So if you're doing a 0.1 lot size, guess what? You lost $25. Big whoop. You might go spend that $25 at the bars this weekend. So would you rather risk the $25 to make 50? You know, or are you going to play the scared role? Or are you going to play the very greedy role and basically say, oh, I needed to go 50 pips in my direction? The market don't move based off of what you want it to do. It moves in its own favor. You want to make sure that your analysis is correct, right? So this is just an example here. Let's see how we're doing on time. We might have a few more. All right. So now let's double it back. Let's look at the 4 hour again. Okay. And let's just look at another pair. And this is considered back testing. This is all we're doing. We're just back testing right now. All right. So let's look at a GBP pair. GBP JPY. This is a solid pair. This is actually a pair that, yeah, actually got this one I'm watching. So I'm gonna see what's gonna happen in this area. So let's go with it. So as you can see here, let me see. Does anyone have any questions? You guys are pretty quiet right now. Any questions whatsoever? Yes, a few. Cool.
My question is really dealing with like placing the support and the resistance lines, but we ain't get to that part yet. So I'm cool on this.
Okay. Solid. Okay, so looking at this area here, right? So right now,